Welcome back, everybody, to another episode of Profitless on Purpose, the nonprofit accounting podcast. I'm one of your hosts, AJ Wheeler, and with me, as always, is Mark Pallardy.
Hey, everyone.
Got a great show for you. We have a couple articles to discuss. The first one is expanding the definition of philanthropy and philanthropist. What it used to mean to be a philanthropist and be in the midst of a philanthropy. Boy, we're using too many philanthropies here. But we'll talk about what it's turning into and how it's changed and is going to change in the new future here. And then our second article is from our always favorite Stanford Social and Initiative Review, and it's called The Dirty Money Dilemma. So how do you analyze who you're taking money from and the risk associated with it? Should you take money from a dirty source, as they're saying here? We'll talk about what that means, some considerations in thinking about it, and some unexpected consequences to some personal experiences and some listed in the article. And then our last article is increasing attention to the decline in household giving to nonprofits. So we talk about how individual giving, those small amounts, those $50, $100 donations that you receive in your nonprofit, have plummeted in the last few years. We'll talk about why that is, why that might change in the near future, and what it means to nonprofits with this kind of philanthropy donation declining. And then our question of the week this week is cash donations. How should you handle it? Should you allow people to take the cash donations that you get and be able to purchase things? What does that mean from an internal control perspective? What your nonprofit should do if it receives cash donations or even checks by the mail, and what the pitfalls are. And we'll even talk about that fraud triangle I'm sure nobody's thought about in a while. Well, you should be thinking about it quite a bit, but we'll talk about that too. Anyway, that's all in this episode of Profitless on Purpose. Mark, do you want to take it away?
Yeah, thanks, AJ. First article up is called Expanding the Definitions of Philanthropy and Philanthropist. And this article by Michael Layton talks about how in our modern era, we have to start thinking broader in terms of philanthropy, and that the collective consciousness has to stop viewing philanthropy as this narrowly defined idea of cash donations, which the shift he suggests, and I would agree, has already started to happen. But, back in the old days, when you hear the word philanthropy, you think of these like big names, big families like the Rockefellers or, the Fords, who were giving cash and, purchasing wings of buildings, which I think AJ is going to get into a little later. But, philanthropy was with a big P, and it was these big ideas of cash. But as we kind of have shifted our ideas of nonprofit and nonprofit giving, the idea of what philanthropy is has started to shift. And basically, as we progress through time, we're starting to view all sorts of other non-monetary items as philanthropy as well. A lot of this has to do with, the growing body of grant making, research, and advocacy focused on building up communities of color. And because communities of color often aren't as flush with cash as some of these wealthier white families were back in the day, but are still very, very focused towards giving, the idea of philanthropy has started to shift. And one of the examples I give is the tradition of giving generously within the Black community. But what that looks like is not just money. It could also be time, employment, education, influence, inspiration, or tangible goods. So that, there's such a idea around this, like, let's not just give money and let the nonprofit work it out. Let's actually get in there, volunteer, and really have our philanthropy from the ground up kind of influence the entire picture. And I think the idea of the idea of shifting helps kind of modernize and democratize, if you will, giving. And so one of the articles, one of the thrusts of the articles is, how do we do this? How do we kind of have a collective action of people for the public good? And so, they want to look at how we engage, communities and collective groups to come together and treat philanthropy in this way and look at philanthropy as a community action and reimagine how we're seeing those, even those making large monetary donations, like seeing their generosity, but also recognizing the generosity of those who aren't giving big, and then how we can express solidarity beyond these formal institutional settings for organizations and foundations, because you may have organizations and foundations that pop up that aren't all about giving money, but you might have a foundation, organized around volunteer hours or coming together. I think like Habitat for Humanity kind of has this, where you're raising the barn kind of an idea. And I appreciate the idea that philanthropy is kind of this living idea, and it doesn't always have to be what we've this staid, plaque on a museum kind of an idea. So what do you think, AJ?
Yeah, I'm actually really glad you brought this up, because I think philanthropy in general, we're seeing a shift. The nonprofit sector always kind of lags behind the for-profit sector. And I think we've seen a big, anybody that's been alive over the last like 30 years has seen a huge shift in the way that business has been done, due to the internet. The big difference in the way entertainment is delivered. If you looked at, in the 1990s and early 2000s, people were still watching like, TV shows and, broadcast television and listening to the radio to a certain extent, and then you see a shift now where everything's YouTube and Hulu and streaming and Netflix. I think you're seeing a similar shift now occurring in the philanthropy space, where you see like I was just listening to a podcast with Mr. Beast, this huge YouTube phenomenon. If you're over the age of like 35, you may not know who this guy is, but you should. But he makes a lot of money, and he has his own charity, in fact, called Beast Philanthropy. And the way that he goes about it is it's all self-funded. So and he gets, like for instance, he gave a turkey giveaway and he had Jenny O sponsor it. And so it's a very different, and the AdSense revenue and everything that goes along with these massive videos that get hundreds of thousands of views and are sponsored, or millions of views that are sponsored. He puts all that money back into this philanthropy or this nonprofit that he has started. But I think you see a change sort of, and like, and this article kind of alludes to it a little bit, where philanthropy just isn't no longer this, kind of pyramid of top down big donors that, you have to go to for these funds. Over the last like 30 to 50 years, we've seen it shift from, being very, private foundation kind of granting and gifts. And like Mark said, buying wings of museums or having your name put on a brick or the side of a building, although that still happens. We've seen a shift where, a lot of nonprofits operate as like a arm of a governmental entity. Private donations, and we'll talk a little bit about a decline in private donations, or like private giving, the small $50 check at the end of the year or whatever from individuals has declined. But I see more influx of money, and you're talking about a social credit here almost, where so and so foundation donated X amount of money to support diversity, equity, inclusion initiatives. That's a really like marketing tool for many businesses now. And I think you're seeing a shift in how nonprofits are receiving money and what type of gifts they're receiving, because Mark mentioned philanthropy is no longer just looked at as a check that's written or an amount of money that's given. I think you'd be hard pressed to find big organizations that don't have like a day of service kind of initiative in their organizations. I think you'd be hard pressed to find, like a lot of these people that make things, or, like our consumer kind of based economy, having extras or leftovers, like those t-shirts you see from Super Bowl winners. They make up 2 sets of them, and the other set goes to Africa to clothe people that don't have. So there's a bunch of people running around with the wrong team for Super Bowl winners in Africa, but it's clothing that would have otherwise gone to a landfill or been a sunk cost that's being given away. So I think you're seeing a real change in like what people consider a donation. And I think that's a good thing. I think the more nonprofit resources they can have at their disposal, the better that they can, arrange how they're going to serve people. And so I would think, like if a development person is listening to this, we always talk about diversifying your revenue streams, and I think that includes in-kind donations, social credit or advertising sort of ideas that can bring money and goods into your nonprofit. I think there's a huge focus right now on like food-based organizations, food scarcity-based organizations. Of course, as we're recording this podcast, the Ukrainian invasion by Russia is a big kind of philanthropy, like, and media touch point. And so I think, all these things combined, I think we're really we're in the midst of a change in how nonprofits are being funded, how marketing of nonprofits is going, and the kind of donations that are coming in and the vast diversity in which they're funded. I think we're really seeing a change here that is it's unprecedented if you're looking at like the 1960s through the 1980s of philanthropic giving. It's changed drastically, I think, in the last like 30 years. What do you think, Mark?
Yeah, AJ, I totally agree with your points. And I think one of the aspects of this that I think is important is the speed of philanthropy is really changing, right? And this is just going to continue to change as we evolve as a society. But, as you're mentioning these buildings and these wings that were built in the 50s or earlier, this took some time. This took some money. Then, of course, there was a lot of rah, look at us, pat us on the back because we did this, because we have billions of dollars. But right now, it's like, as you were mentioning with Ukraine, or, a lot of these Red Cross efforts that happen, it can be immediate, where giving is immediate, and the impact of millions of people giving a little bit can frankly be much larger than some big organization or even a governmental agency saying, we're going to give this big chunk of money. So you actually can have this collective worldwide community that comes together. And I know in past recent podcasts, and something we'll delve into as it all unfolds, cryptocurrency also is kind of on this new wave where we talk about anonymity of giving, and not even just getting away from big cash donations, but getting away from money altogether, right? And having it be these electronic non-traceable funds kind of a thing. So I think I'm excited that the idea of philanthropy just continues to evolve and grow, because I think it's it's a growing space, and we need to stay on the cutting edge to survive. How about our second article, AJ?
All right. Speaking of money to survive, we have one of our favorite nonprofit news sources, the Stanford Social Innovation Review, called "The Dirty Money Dilemma." So this is an article by Lauren Taylor, and I think she did a really good job of kind of really diving into and what she's talking about is how should a nonprofit decide whether to accept or reject a donation from a controversial source. And so her kind of tagline is start by thinking about what the nonprofit gives in return. So she gives some examples of this, and we kind of alluded to it in our first segment here. But like the Shackler family, I hope I'm saying that right, because I'm going to drag their name through the mud here.
Sackler.
Okay. Sackler family, who was involved. Who was involved in essentially marketing and profiting from an opioid epidemic due to OxyContin. Back in like the late 80s, I think they had gave to the Met a lot of money to have a wing of the Met expanded, and their name was on it. So fast forward to when they got in trouble for essentially either creating or like making it very possible for profit to have an opioid epidemic run rampant in America and elsewhere, and got taken to court for it. This negative PR that came upon the Met caused horrible PR for them, and they actually had to rebuke and like essentially say they were no longer taking any gifts from this family. Another one that they had mentioned was like talking about like some organization, or excuse me, some school that was doing essentially health health research was had to return or turn down money from Philip Morris, the company that makes like Marlboro cigarettes, or one of the cigarettes. And so it talks about a couple other kind of interesting donations. And what this author did is they've actually done research over the years into what affects, I guess, how nonprofit leaders look at donations. So one of the questions that she posed in her research was she interviewed 44 different nonprofit managers, and essentially and about their willingness to accept various configurations of donations. Meaning, and what she's trying to get at here is, it's never is, nobody just hands over money to a nonprofit. There's some kind of back and forth that happens here, some kind of acknowledgement for what they're giving. They may be giving out of the goodness of their heart, but it's going to come back to them in some way in which they receive either, like a feel good shout out, actually naming a building after them, public, kind of acknowledgement of their donations. But the question that she would pose would be, would you accept a donation from the American Nazi Party if both parties agreed it would never be publicly acknowledged? And she said some would and some wouldn't. And the dividing factor there was the actual amount of money that was being offered. So if it was $1,000, people were very quick to say, heck no, there's no way we would take a donation from the American Nazi Party. But if that amount was raised to say $1 million, there was quite a few people that would consider taking such a donation because they felt like it was better used in their hands than, in the hands of like the American Nazi Party. So it was an interesting kind of dive in to understand how nonprofits think about money being donated and who it's coming from. We've talked on this podcast before about aligning your investments with your mission and vision. But this article kind of dives into more thinking about aligning your donations or the donors that you're receiving money from with, and understanding the risk. So she actually makes a risk table and kind of puts it on a spectrum of like the types of influence that somebody would have and recognition, and, kind of going from the risk of harm, or the risk kind of being low risk of harm, and a high risk of harm, and the type of influence that the donor would have, and the types of recognition a donor would receive from donating money or goods and services to an organization. And so she gets into what allowing influence is. Of course, we know this is, dictating how that money and where and when it'll be spent, essentially restricted, with donor restriction of net assets, and then the recognition, is their name going on the side of a building, or is it quote unquote anonymous? And because donation stuff like this can often be public record, realizing that and understanding that. Yeah, I think understanding that, and taking that into consideration is allowing that. So I'll let Mark weigh in here, but essentially she goes through it's a very good article, and I would recommend that everybody take it. But her recommendations are to clarify the potential harms if you're considering taking money, avoid overly simplistic decision frameworks like deciding, just to take it because the money's here, and increase communication and consider a structural solution. And so they're talking about to remove the moral burden from individual decision makers, a blind trust, an account managed by a third party, such as a local bank, and so that you're taking that blind trust and you're setting it up in a bank, and people that want to donate to this blind trust, and it's creating like almost like having like a parent company or something. It's creating a veil between this. So I think, being able to weigh in on all this, I'll let Mark kind of speak to him and his ideas on this, but I thought it was a very interesting article and stuff that I hadn't really thought about. We've discussed, kind of be aware of where your donations are coming from, but, discussing, it in depth like this, I had never thought of it that way. So Mark, what were your thoughts on this one?
Oh, dirty money. I think, there's so much to say on this topic. I'm going to just start with the Sacklers because, interestingly enough, on the day we're recording this, I just heard a story on NPR this morning that a whole bunch of victims, not all clearly, but a whole bunch of victims from the opioid epidemic, be it family members of deceased people or people who are recovering, met in court today because they're about to make this final adjudication to let the Sacklers off of any future legal liability in exchange for $6 billion of their wealth going to all these different programs. But part of the deal to help them avoid future litigation was that they would have to hear from victims. And boy, it was rough. I mean, some of the language, and they brought into this story the idea of some of these organizations that have taken philanthropic money from the Sacklers and what they're going to do now. And you have to kind of think about it in a few ways, right? Like if I'm the Met and I've taken money in the past from the Sacklers, is it my responsibility to then give that back if I find out they're bad people, right? And to find out that these ill-gotten gains were on the backs of the deaths of a lot of people. Like if I didn't know who they were at the time of the giving, it sets up a precedent where it's like, if the idea is, now I have to give back this money, then it sets up this precedent that every nonprofit needs to vet their donors before accepting money from them. And that seems impossible to do, right? So, and then of course, you've also got tons of nonprofits that are organized around a political ideology, right? And so, as it aligns more with one side or the left, are you going to take money from people who are questionable? AJ and I have talked in the past about, there's some nonprofits that get flack for taking money from cannabis organizations or other illegal organizations because the donor base might view it as questionable. I mean, the extreme that AJ brought up with taking money from the Nazi Party is a ridiculous extreme. But this is happening all the time on a much lesser level, where you've got a donor base or people in the organization who might question whether you taking money from this group of people is proper. And of course, as we know, nonprofits often are just struggling to survive, and they want to take money if money is being given to them. So it really is a dilemma, because sure, with the Nazi organization, it seems pretty cut and dried, but then you get to this place of, well, do I use their ill-gotten gains, or, should these ill-gotten gains actually be given back to help people who suffered under their, awful regime? So some of these questions come into play, and there's a PR issue here that's huge, because if you knowingly take money that is dirty, right? If you're taking money from the mafia or whatever, drug overlords to fund your nonprofit just because you happen to be their pet project, if that comes out later and you have knowingly taken this, that could tank your nonprofit completely. And so it's not always about the money, it's about also the longevity and your ability to continue to service people. Now, one of the other aspects that AJ talked about that I want to bring up, because I think this author lays this out very well, and it is a fascinating topic that we probably could have spent the entire podcast on today. But there's this chart that the risks of influence and recognition is a slippery ass slope, right? Because, I personally have worked at a nonprofit organization where one of the donors to a large exhibit tried to influence the content of that exhibit and basically said, oh, you're being too harsh to white people in this exhibit, so we want you to change it. And luckily the ability to say no to this donor was available, but you don't know when it is and when it isn't, and how often decisions are being made so as not to piss off a big donor, or to kind of keep things milquetoast so that you're not offending anyone and that the donations keep rolling in. So it is a real slippery slope. And I think, I would say we welcome your feedback and your commentary. And of course, you can always tweet us at Profitless Pod or put comments in the YouTube to just kind of give us your ideas of where does that decision get made? How do we do that? AJ.
Yeah. I too have had an experience of working with a nonprofit that they were in, like drug addiction recovery, right? And they were actually offered like here in Oregon when medical and recreational marijuana dollars came into effect, they were offered money from those pools of money, and it was a large discussion on whether or not they should accept that. I mean, it's not quite as bad as taking money from like big pharma, or something that somebody had an opiate addiction, but it's definitely something that you need to weigh in on and think about before you accept that money. Even internally, say this isn't even external, right? But say that internally, there's some people with some really, hard beliefs that, like if they're drug free, for instance, in a recovery program, that they shouldn't be accepting money from something that could, quote unquote lead as a gateway to addiction or something like that, so, or a pharmaceutical company, the offering money for drug rehab as part of their, court settlement. Should they take that kind of money? Like that money could be put to good use, and it usually comes, in quite a sum. But what does that look like internally? And so it's one thing that the article didn't really get into, the internal pushback you can get, but the external kind of pushback you could get if you had to publicly acknowledge, you received money as an addiction, recovery center to have taken money from like a pharma company. And we've talked about before, like on this podcast about how investing it is or whatever, or yeah. So I think, yeah, it's and the alternative, thinking on that is, sure, drug money should go to rehab because it's the cost of selling drugs, so how do you it's coming from a bad source that created the problem, but now it's trying to be rectified. It's a balancing act. And I think this, risk of influence and recognition it's kind of weird to think about putting philanthropy on like a SWOT, like a external and internal threat board. But I think it's something, in this day and age, you probably have to consider, because media has been democratized, and at any point somebody can put your nonprofit on blast, as the kids say, about who and when you got money from, and how that affects your social credit, and your social bottom line.
Yeah, so. Buyer beware if they ever say, "Oh, this will just be between us." we know how that works.
Yeah, no longer is it, you can write on the back of a Post-it note and throw it away. There's some kind of digital footprint here that's made. So just be aware of that. And I think, please take a look at this article, because Mark and I have found this very fascinating. It's well written and well worth the read. So Mark, you have another uplifting article, I think, for this week.
Oh yeah. Us always bringing the joy here on the Profitless on Purpose podcast. This article is from Michael Moody, and it's part of that 11 trends in philanthropy that we've been talking about recently. And this is called Increasing Attention to the Decline in Household Giving to Nonprofits. So basically, this is coming from some studies that are a couple of years old now, but back in 2018, the number of American households that said they give to charity dropped below 50% for the first time. And then when they kind of reassessed this in the year 2000, when they looked at it in 2000, it was about 66%. So within that 18-year span, we're looking at a 16% decrease in household giving. Why? For those households that do give, the average is also falling. So not only do we have fewer households giving, but the actual average rate of giving is also going down in those households that do give. And the only outlying factor to this are the wealthiest families, which seem to be giving more. And that's kind of this discrepancy, this disparity between the haves and the have-nots. But the actual movement of cash outlay and money coming in from nonprofits seems to be skewing towards the wealthy. Now, the outlier here, of course, is the pandemic, because giving was up all around during the pandemic, because during a crisis, people tend to give more. But they're anticipating that trend won't continue. So again, why is this happening? People don't have a definitive answer for this, but there are some indicators kind of pointing at what's going on here. So disposable income has gone down for the middle income and working class. And there's also household traditions that have declined as well. So religiosity, so people attending churches and belonging to a religious group, social capital, and trust in institutions. So, there's a lot of talk out there about institutions and, big government being bad, and we can't trust any big institutions anymore, et cetera. So we might be giving less to them. And also, I would add to that mix, as social media proliferates, we get lots of news, good, bad, fake, real, whatever, about everyone. And people will cherry pick what they want to believe, and people will have information at their fingertips, sometimes false information, that will lead them to either justify what they're doing in one way or another. I mean, there's a metric shit ton of confirmation bias out there either way, and that can lead to more, people holding on to their money while they're trying to make a decision, or just not feeling in a very giving mood. So how do we combat this? Basically, are we just going to shift to a society where we're looking at just getting major gifts from big organizations and, putting the power in their hands? Or are we going to do something else? And I think we kind of already alluded to that. I already spilled the tea, if you will, in the first article, where we start to shift towards everybody giving in other ways besides monetarily, right? Because these kinds of metrics don't necessarily point to what kind of other giving is going on, the non-monetary kind, the coming together as a community, and the raising the barn, if you will, and working together, in-kind gifts, et cetera, aren't necessarily captured entirely by that metric. So I think expanding the view of giving and focusing on that can be one factor. Obviously, excuse me, the biggest way to change this kind of giving is to change society and have everybody get up on an equal economic footing. But call me when the shuttle lands. I think we all know when that's going to happen. So, AJ, with my cynical view in mind, why don't you give us a little bit of uplifting news here?
World peace, man. No. I think so. It's interesting. What I, spoiler alert, I'm an accountant and I did my taxes a couple of weeks ago here, but I'm wondering, this kind of looks back, of course, at the last few years. And if anybody remembers, the tax break for giving charitable donations for us ordinary taxpayers that are below $1 million a year in earnings or whatever changed under that tax act that Trump had put in, that essentially gave you more of a standard deduction and kind of make lawn filing less attractive and such, and then allowing individuals now, though, I noticed on this tax form that there's a line that you can take a straight, I think it's $300, deduction for charitable donations. I'm not a tax accountant, so don't quote me on that. But if my memory serves me, I think that's what it was. And so what I'm wondering is, if people are aware of this, if that tax code change happens, if we're going to see an uptick in maybe these smaller donations, and see maybe this trend kind of reverse, because I think one of the things that they said here is, this tax incentive being one of the ways to change this. I also think, understanding, we talked earlier in the podcast about different kinds of giving. I think a lot of people, of course they think, I got a bunch of clothes that I don't fit into anymore, or I need to take this stuff to Goodwill, or I got a old tube TV that's been sitting in my garage for 5 years. But if we think about things like going through your pantry and being able to donate canned foods you maybe don't use, and the different types of giving, this article of course focuses on greenbacks and financial donations, but I think redefining how people donate, I think is good to know. And I think those in-kind donations or gifts of something other than just money and gifts of time and volunteering. I think you're seeing much more engagement from that side. I think we have a generation that, because of social media and because of like the openness of the openness of the internet, the appearance of, being very transparent through the internet has, made people want to volunteer, with everything that happened with BLM and George Floyd. I think you see a lot more people interested in that kind of equity, diversity, and inclusion work that goes on, and volunteering in some of those lower income neighborhoods to support, the all a rising tide that rises all boats, I think. And so you're seeing, I think, if we just focus on the money, I think you may be missing out on some of this. And again, I go back, I'd like to see these numbers run after a year or two of having that, $300 tax break for individuals and small filers. So I don't know, but did I miss anything, Mark?
Yeah, no, I think you nailed it with that tax comment, because I thought about it when I was reading the article, but I failed to mention it. But it's a bit of a cynical view to think, well, I'm only going to give if I'm going to get a tax deduction from it. But, it is a factor that considers into people's giving profiles. And when it was part of, when it was an itemized deduction, and that was a more viable route for a lot of people to file on their taxes, I definitely know I've worked with some clients who are like, oh, if I just give a little more this year, that works out better for my taxes. Whereas if the standard deduction for a couple is, upwards of, it was 24,000 when it started, it's probably upwards of 25,000 at this point. That's a lot of mortgage interest deduction and, whatever. We don't need to get into the weeds of all that to reach that threshold of giving. And, giving that extra year-end push of $500 ain't going to push the needle at all on your taxes. It's a factor. People are thinking about these things. And while it may be cynical and we want to just think everybody's giving for altruistic reasons, everybody's got a budget as well, and everybody's got to factor in all the different pieces. So, I think I'll leave it there. And I think we got a interesting topic this week, a question of the week. AJ, take it away.
Yeah. All right. So this is regarding cash donations. I think the title of the question is kind of misleading, and I'll tell you why. Anyway, essentially, this is somebody that their boss has been doing charitable work for quite a while, and it's always been really small. And essentially, what this is if you know what Toys for Tots are, or like any of those kind of toy drives that happen around Christmas time for the less fortunate, this is essentially what this person did. And what they would do is they would accumulate a couple $100s a year, and they would then go and buy these gifts for children that were in need of a Christmas gift. And so essentially this year, or the year before, this had become quite big. We're talking maybe even tens of thousands of dollars, I think they're alluding to. And essentially this person advised that they need to become a 501c3 because too much money she was becoming really well known in the community for this work. So they finally got their 501c3, and it's been super beneficial to them. They've been able to solicit more donations, provide people with a tax, receipt that they can, take their $300 off on their tax return, as we just talked about. But essentially the problem here is that they want to do it the way that they've always done it. Essentially, they were going to take the cash and divvy out the cash to these volunteers or to these people to go then into the community and buy these toys and then provide them. And essentially what this person is proposing is that, and I think rightly so, but we'll get into it, is that cash, what they need to do is they need to take the cash, they need to put it into a bank account and then buy gift cards for volunteers or for people to go out and purchase the toys with. Now, of course, it's a headache. Why does this need to be a two-step process? We have the cash in hand. Why can't we just go buy these toys? And so what the person is saying is the kind of thing here, I want to make sure our accounting is done properly and able to withstand an audit or donor and public scrutiny. Any advice would help on whether or not they're being overly cautious with this, or if they, or if they're in the right mind of thinking where the cash needs to be put into a bank account and then gift cards purchased and approved and done out. I'm kind of alluding to my answers to this question, but I'll let Mark kind of weigh in first here. Should this nonprofit just be allowed to, use the cash that they receive in donations to be able to buy the purchases? Or do you think this person is making a smart financial and controlled decision to put it into the bank and then, purchase gift cards with that to send out?
Yeah, I mean, this organization decided to organize themselves as a 501c3. So with that comes some standard procedures and things that you want to do, right? So I think there's a few questions that this would bring up to me. First being, are the people who are giving the cash, are they wanting a receipt for this donation? Because if they are, then you need a money trail, right? Because that is where, if IRS audits you, or if you have a single, if you get large enough that you need an audit from an independent auditor, cash is never an ideal situation to trace money. This is if people want to give anonymously a cash donation, great. Then, and they don't expect that, great. I would still say put it in the bank and then use those funds to then purchase things with that money going into the bank. The problem is that when you just take in cash and then spend that cash, it never makes its way into the books. And effectively what you're doing is similar to a barter transaction where you're not recording that barter and your nonprofit looks much smaller than it is. That doesn't help you in the future if you want to get grants. That doesn't help you in the future, on audits. So I don't know about the gift card idea, however that works. If you want to purchase toys for kids, you could certainly put the money in the bank and then have, somebody go out with a company credit card and go out and buy toys and give out the toys. I'm not going to pretend to have your operations ideas all for you, but cash is problematic for a lot of reasons. And, I understand people wanting to just give cash, and certainly anonymous cash donations are always welcome, but they also need to be tracked and they need to go through a bank account so that they can hold up to scrutiny later on.
Yeah, I think what you're saying is correct. And I think the other part of this is, and from my auditing background, cash is risky, right? Anybody can take cash, and even if you require receipts, you're not, this cash that's given out, you're never going to purchase something unless you're in Oregon, right? I guess, and there's no sales tax. You're never going to give somebody $50 or $100 and go to the store and use every penny of that $100. And you run the risk then of somebody, sure, purchasing something, somebody digging a receipt out of a trash can and saying, here's what I bought, and I put it over and I gave it to the kids at the Salvation Army, toy drive or whatever it is, right? And so the thing that I think this question is getting at is having an adequate set of controls over your expenditures. And what you don't have with cash is really control of where that cash goes the minute it leaves your hand. And there's all kinds of funny business, and the examples I use are, kind of the low end, fraudulent scheme that could happen. But cash, I remember our auditing teacher in college said, if you deal with cash, it's not if you're going to get cash stolen from you, it's a matter of when. And it, it's just really, and much like cash, a debit card would kind of be the same way. Our ears always, as an auditor, our ears and spidey senses always went off when somebody had a debit card to their bank account, because essentially a debit card is one step away from cash. You can swipe that with a PIN, you can get a cash back. You can withdraw money if you know the PIN. So debit cards were usually frowned upon. It's almost the same as just giving somebody the keys to that bank account. Gift cards are a little different. You have backup there, but I'm thinking, gift cards in this situation might be, even more so, now somebody has this gift card that they're running around with that has X amount of money. Although it limits the amount of fraud they can perpetrate, it's not much different than handing them cash. I would say, I guess if this was my organization and I was making or I was consulting with this organization, I would suggest that what they did is they take all that money in and they, do online shopping. or they're, like partnering with a toy company in the local area, a brick and mortar toy company, to be able to say, let's pick everything out, and then you give us an invoice that then we can write you a check directly to be able to pay for these things. What you're really trying to do is make sure that the person that has receipt of the cash isn't then also having carte blanche to spend it on whatever they want. You want to make sure that those cash donations that are coming into your nonprofit are being spent correctly. And the only way to do that is to have oversight into how they're spent. So I think this person is on the right track of wanting some kind of money trail. I think adjusting how you think about that, it would be much better. I mean, you could also use, partnering with the local toy company as a way to bolster the amount of people you could serve, having acknowledgement of them, or maybe having them kick in and match your donation, or kick in free toys or something like that, could really benefit the organization and be a win-win in this. Or partnering with a bunch of different, I don't know the location of this person writing in, but, if you're a small town, there's got to be one toy store there, or a Walmart, or something like that. So partnering with that, or trying to get community engagement behind this, I think would be really beneficial to not just your control structure, but the donation side of what you're doing. So I would look at it and maybe propose it in that sense, where you can get a lot more traction, media coverage, and control over this cash that you have donated by doing something like that, and having a paper trail that's not just cash or gift cards going out.
Yeah, and I while you're bringing up the idea of fraud, I just want to revisit from our old accounting days the old fraud triangle, right? With cash, where you have custody on one side, recording on another side, and authorization as the third point of the triangle. And whenever you have one person doing two of those tasks, the likelihood of fraud goes up greatly. And just having somebody have cash and then spend it on something, that is your custody and your authorization happening immediately, and you might not ever even record it. So yeah, I think AJ is spot on with the idea that you need to create a process, and you need to have some internal controls for this.
And please, for God's sake, write it down. I see a lot of very small nonprofits and startup nonprofits that don't write any of this stuff down. Make it easy for people to understand the flow of how this all works, like document, especially if you're thinking about getting audited or donor or public scrutiny. If you have, policies and procedures in place and can show somebody that their money was used correctly, it's kind of like a fail-safe switch, right? Like, you may never be approached about it, but if you are, you have the written policy in place. You can show them the receipts. You can show their flow of money. It came into the bank account and it was spent in this pool of money to go to exactly what you thought it was going to. Whereas if you have this cash thing, somebody comes back and asks, I've donated a lot of money over the last few years, and how did you spend it? It's like you're kind of at a loss to be able to even be able to do that. So I think having receipts, in more ways than one, makes a huge difference. And I'm not just talking about the receipt that you get from purchasing the thing, but you have the authorization that it's okay to purchase these things. You have an invoice that shows it. You have a receipt that shows it. You have that money being recorded into your financials, and it's not just kind of, swept under the rug and a pile of cash that's sitting there waiting to be spent. I think, document, how the process works. What if this woman that started this, moves to a different town or gets an inheritance and moves to the Bahamas? How does this continue? I think this is a good organization that probably provides really good services. You have to have all that written down and understand how this works, and have policies in place for people to follow. Because it sounds like this nonprofit is going to, continue to do well in the community. So, yeah.
One funny aside, AJ, I've been at a couple of organizations where they get cash donations, and then the impetus, like with a check coming in the mail, is that they want to photocopy that cash. Don't do that. That's called counterfeiting. And yeah, just don't do that. Okay.
Well, the gold standard, right, is to have somebody, like, especially if you're receiving cash, have two people present. It's much harder to get two people to agree to fraud, and if there's collusion, you're not usually going to find it anyway. But have two people there together when there's cash in the room and recording it. And that goes for checks too. Write it down somewhere, and have people sign their name to it. And, you can search internal controls for cash procedures or internal controls for, receiving checks and find it very easily on the interwebs. And, I think understanding the risk here, but yeah, have two people present, you know what I mean? And if they don't like each other, even better, because then they're not going to collude, so yeah, if you got polar opposites in the office, stick them on opening envelopes together and recording cash donations. I joke, but I mean, I'm half serious here that, you need two people present when receiving cash or checks from the mail. It's always a good idea.
Agreed. All right. I think we beat this one to death. So a simple question, but a complex answer. So thank you, everybody, for joining us again for another episode of Profitless on Purpose. We sure appreciate you joining us on these intimate discussions on issues related to nonprofits. We certainly welcome your feedback here on YouTube or at Twitter, at ProfitlessPod again is the handle. And, give us your feedback. Send us some questions because we're always looking for new ones. And on behalf of AJ and myself, we certainly appreciate you being here, and we'll see you next time.
Thanks, everybody.